Hey, Todd Halleck here today. Wanted to talk to you a little bit about designating beneficiaries on your retirement accounts and how that relates to estate planning. A couple of years ago, we had some big changes to the the rules for retirement accounts, especially as it relates to estate planning. And we just recently, in the last several weeks, received some proposed regulations relating to those rules from the IRS. And now the House of Representatives has just recently passed what's known as Secure Act 2.0. The original act back in 2019 was the Secure Act, and now the House has passed Secure Act 2.0 that may be bringing some additional changes. So retirement accounts tend to be one of the bigger assets most of my clients have, and there's some really significant estate and income tax planning consequences in dealing with retirement accounts. Most assets that a person inherits at death are not subject to income tax. That's not the case for retirement accounts, or at least it's not the case for traditional retirement accounts like 401ks, 403bs, traditional IRAs, those sorts of things, as opposed to a Roth IRA. So when it comes to retirement accounts, one of the first questions we're going to ask is this a Roth IRA or is this a traditional IRA? When it comes to a non-spouse beneficiary with a Roth IRA, the rules are basically the same as they are for a traditional IRA. With a Roth IRA, the original account owner never needs to take a required minimum distribution, and the surviving spouse, if he or she is the beneficiary of that Roth IRA, also does not need to take a required minimum distribution. For a traditional IRA, a 401k, something like that, depending on how old you are, will depend on when you have to start taking mandatory distributions. If you had turned 70 and a half prior to December 31st of 2019, you're already taking your required minimum distributions. If you did not turn 70 and a half prior to that day, then your required minimum distributions will take effect on age 72. And that's something that the Secure Act 2.0 may be changing, but right now, for anybody who hadn't already turned 70 and a half by December 31, 2019, they will start taking required minimum distributions in the year that they turn 72. How much those required minimum distributions are is going to depend on how old you are and how large your account is, but those will need to be taken each year. Failure to take your required minimum distribution results in a penalty for failing to do so. The question then becomes, what happens to that account when someone passes away? So the first question we ask is the beneficiary that's listed on that retirement account, is that a designated beneficiary, individual, or trust? If the answer is no, then the next question is, has the person hit the required beginning date? For someone who was 70 and a half prior to December 31, 2019, that's their required beginning date, the year they turned 70 and a half. For someone who wasn't that age by that date, their required beginning date will be on their 72nd birthday. So has the person reached the required beginning date? If they have reached the required beginning date, then distributions are made to that beneficiary based on what we call the ghost life expectancy of the original account owner. So we continue to require distributions to the new beneficiary based on the same time schedule as those distributions were required to be made to the original account owner. If they have not reached the required beginning date, then it's what we call the 5-year rule. All of the distributions need to be made within 5 years of the date of death of the original account owner. There's no minimum or required distribution during that 5-year period. So when we're dealing with a non-designated beneficiary, we want to think about, are we using do we want the ghost life, or do we want the 5-year rule? That may make some sense or that make a difference in who we designate as the beneficiary. If the answer to is the beneficiary a designated beneficiary, individual, or trust, then if the answer is yes, then the next question is that designated beneficiary what we call an eligible beneficiary? If the answer is no, then we're going to be dealing with the 10-year rule. The 10-year rule means that all of the assets of the retirement account need to be distributed and taxes paid, if any, within 10 years of the date of death of the original account owner. If it's a Roth IRA, it doesn't matter whether or not the person has hit the required beginning date or not. You just have 10 years to get all those assets out of that account, and in the case of a Roth, there wouldn't be any taxes due. If it's a traditional IRA or a tax-deferred account, then the next question is that account owner, has he or she hit the required beginning date or not? If he has or she has hit the required beginning date, then the beneficiary will have a required minimum distribution for each of the 10 years during that 10-year time frame. If the account owner has not hit the required beginning date, then that beneficiary can wait the full 10 years before withdrawing the assets and paying taxes on those. So it's going to again depend on, has that original account owner hit the required beginning date or not. So is the beneficiary a designated beneficiary? Yes. Then the next question, is that beneficiary an eligible beneficiary? If the answer is no, 10-year rule. If yes, then we're looking at who is that beneficiary. If it's a spouse that's the beneficiary, then they will be able to take the assets out based on that spouse's life expectancy. They could also potentially do a rollover of that retirement account, or they could, like I say, take it as an inherited and use their life expectancy. That means we're going to look at how old they are and determine payments over any number of years, maybe far in excess of 10 years. So they'll have a lot longer time to take distributions. So normally if you have a spouse, that's going to be your best beneficiary because he or she will have the most options when determining when to take distributions. If it's not a spouse, is it a minor child? If the beneficiary is a minor child, then until that minor child reaches the age of majority, we'll use their life expectancy. So they will get a distribution each year while they're until they hit the age of majority. And then after they hit the age of majority, then the 10-year rule comes into effect for them as well. Same thing when the original owner passed away, had they hit the required beginning date or not. For determining whether they have reached the age of majority, instead of trying to go state by state, the IRS has said 21 is our age of majority. Unless the child is still in college, then we can go till age 26. So that's the rule for determining when they've reached the age of majority. The next one, if it's not a spouse and it's not a minor child, is it a person that's less than 10 years younger than the original account owner? So if the person that's your beneficiary is less than 10 years younger than you, maybe it's a brother or a sister or some sibling, then we're going to be looking again at that person's life expectancy. So they could have much longer than 10 years to take out the distributions and pay the taxes. And then finally, if it's not one of those three, is it a disabled or chronically ill individual that meets that definition? If it's those folks, then again, we're getting to look at life expectancy. This area with disabled or chronically ill beneficiaries is a place where you can really do some great things in your planning to defer those taxes. Again, we're really trying to defer the taxes on those income taxes on those retirement accounts as long as possible. That's how we're going to analyze your beneficiaries. There's one thing I haven't put up here, which would be a charity. A charity isn't going to pay taxes when they receive a distribution from a retirement account. So that charity can be a great beneficiary, especially if you have a potentially taxable estate for estate tax purposes. Why do I say that? You know, if you've got $1 million in your retirement account and you're going to pay estate taxes on it, well, that's 40% of $1 million that's going to the IRS for estate taxes. If you then have to pay, you also then have to pay income taxes. Say you're in, 37, so so you got 400,000, another 370,000 that's going to the IRS. I mean, very little of that is now making its way to your children. And so maybe you take that full $1 million, send it to the charity who isn't going to pay estate or income taxes on it, and lowers your estate tax liability, which maybe increases the amount of assets that are coming from another area of your estate for your children. So retirement accounts, they're not simple, right? There's a lot of different, and this is a lot of different ways things can go, and this is a really simplified version of the analysis that myself or your accountant or your investment advisor is going to use in looking at that. So it's important to, as you're planning your estate, think through how the retirement accounts are being addressed, because they are more and more one of the more substantial assets that a person has in their estate, and they can cause both income tax liability and estate tax liability, and that's just money that's not going to your family, or your favorite charity. That's money that's going to the government, and as much as we know we need to support the government, none of us loves to pay any more than we need to. So I hope that's been helpful for you in thinking through that a little bit. I encourage you to talk to a qualified advisor to help you work through these issues in your personal estate. If you like what you hear today, please subscribe to this channel, and we sure appreciate you.